Money isn't simply printed. Much of modern money is created through the banking and credit system, and understanding that system helps you understand the economy itself.
Where does money come from? Imagine waking up in America and realizing that almost everything you do involves money. You buy coffee, pay rent, receive a salary, swipe a card, or transfer money online. But have you ever stopped and asked yourself one simple question? Where does money actually come from? Is all money printed? Many people imagine that money is created when the government prints more dollar bills. But that is only a small part of the story. Most of the money people use every day does not exist as physical cash. It exists as digital balances inside bank accounts. David wants to buy a house. A few months later, David decides to buy his first home. The house costs $400,000. But David does not have $400,000 sitting in his bank account, so he walks into a bank and applies for a mortgage. The $320,000 loan. David gets approved for a $320,000 mortgage. Now comes the fascinating part. The bank does not necessarily take a pile of $320,000 in cash from a vault and hand it to David. Instead, the bank records a new deposit in David's account. A loan creates a deposit. In modern banking, a new loan is generally recorded as an asset for the bank, while the deposit created for the borrower is a liability of the bank. In simple terms, the loan and the deposit appear together. This is one of the most important ideas for understanding modern money. What does the Federal Reserve do? So where does the Federal Reserve fit into all of this? The Federal Reserve is the central bank of the United States. It does not operate like the commercial bank, where David keeps his checking account. Instead, it influences financial conditions throughout the economy.
Interest rates change behavior. One of the most powerful tools is interest rates. When borrowing becomes cheaper, people and businesses may be more willing to borrow, invest, and spend. When borrowing becomes more expensive, they may slow down. A single change in interest rates can influence millions of financial decisions. Money is more than cash. David buys a $6 coffee. He does not hand over a physical bill. His bank account is reduced and the coffee shop's account is credited. No truck full of cash moves between them, yet a real economic transaction has happened. Not at all. Banks cannot simply create unlimited money whenever they want. Lending is constrained by capital requirements, liquidity, regulation, risk management, funding conditions, and most importantly, the demand for credit from borrowers who can realistically repay their loans.
Money and debt are connected. David now owns his house, but he also has a mortgage. The bank has an asset, David's promise to repay. David has an obligation, monthly payments plus interest. This is why modern money and credit are deeply connected to debt.
What happens when credit expands too quickly? Now imagine a city where there are only 1,000 homes, but suddenly buyers have much more purchasing power and are willing to pay higher prices. The number of houses has not increased overnight, but demand has. Prices can rise.
Inflation is not just about printing cash. This is why understanding money requires more than asking how many dollars exist. We also need to ask where the money is flowing, how quickly credit is expanding, whether production is growing, and what people expect about the future.
Why does money have value? David holds a $20 bill in his hand. The paper itself is not worth $20 because of its physical materials. Its power comes from a shared social belief that other people will accept it in exchange for goods and services. Money works because people trust the system behind it. The real financial system. Behind every dollar is a much larger system. Banks, borrowers, businesses, consumers, central banking, credit, debt, laws, expectations, and millions of transactions happening every day. Money is not simply something printed and placed into your wallet. It is part of a living economic system. The question you should ask. So the next time you look at the money in your wallet, remember this. Money is not just paper. It is a system built on trust, credit, debt, banking, monetary policy, and economic activity. And once you understand how money is created, you begin to understand how the entire economy moves. Because money is not just something you earn. Money is a system you need to understand.